I just bought shares of a battery company that most investors have never heard of. While everyone's chasing Tesla and the Chinese battery giants, I found a Canadian company that's quietly building one of the most profitable niches in the entire battery industry. Electrovaya trades at just $6.20 as of September 4th, 2020. But this company has something Tesla doesn't. Batteries that last 4 to 5 times longer than the competition and customers, who will pay premium prices for that performance. Today I'm breaking down exactly why I added ELVA to my portfolio and why this might be the most overlooked battery play in the market. Let me start with what makes Electrovaya different. This isn't another electric vehicle battery company trying to compete with Tesla. Instead, they focus on industrial applications. Think forklifts, airport equipment, and warehouse automation systems. Here's the key insight I discovered. While consumer batteries in your phone last maybe 2 to 3 years, Electrovaya's industrial batteries deliver over 9,000 charging cycles. That translates to roughly 3.5 million cumulative miles of operation. Their secret weapon is something called infinity battery technology, with proprietary ceramic separator technology. While most lithium-ion batteries give you 2,000 to 4,000 cycles, Electrovaya's deliver 9,000 plus cycles. It's not just incrementally better, it's a completely different value proposition. Think about it from a customer perspective. If you're running a massive warehouse operation 24/7, would you rather replace your forklift batteries every 2 years or every 8 to 10 years? The total cost savings are enormous, which is exactly why Fortune 100 companies are willing to pay premium prices. Here's what made me pull the trigger on this investment. The growth numbers are absolutely explosive. 2022 revenue, $15.6 million. 2023 revenue, $43.4 million. That's 171% growth in a single year. But here's what really impressed me. They're not sacrificing profitability for growth. Their gross margins improved from 25.7% in 2023 to 30.6% in 2024. They've been consistently profitable on an adjusted EBITDA basis for 8 consecutive quarters. Q2 2025 revenue hit $17.1 million, representing 67% quarterly growth. For a company this size, that kind of sustained growth while improving margins is exactly what I look for. The company has secured over $65 million in cumulative orders through the first 9 months of fiscal 2025. That's not speculation about future demand, that's confirmed business in the pipeline. This is where Electrovaya gets really interesting. Their customer list reads like a who's who of American industry. More than 14 Fortune 100 companies across 170 warehouse sites on 4 continents. One customer alone has over 2,800. Electrovaya batteries across 50-plus distribution centers in 3 countries. Another Fortune 100 customer recently placed a $7.3 million order. These aren't price-sensitive consumers shopping for the cheapest option. These are massive operations where downtime costs thousands of dollars per hour. When your warehouse needs to run 24/7, you pay for reliability. The company's largest partnership is with Raymond Corporation, Toyota subsidiary, and the world's largest forklift manufacturer. They've secured 3-year strategic supply agreements with minimum purchase requirements. That's the kind of customer stickiness that creates predictable revenue streams. Here's what convinced me this isn't just a growth story, it's a sustainable competitive advantage story. First, the technology moat. Electrovaya's ceramic separator technology isn't just marketing fluff. Independent testing shows their batteries lasting 4 to 5 times longer than competitors. Once a customer deploys these batteries and sees the performance difference, switching back to inferior technology would be economically irrational. Second, the switching costs are enormous. When a Fortune 100 company deploys Electrovaya batteries across 50 distribution centers, they've invested millions in training, integration, and operational procedures. The cost and disruption of switching suppliers creates natural customer retention. Third, geographic positioning. While Chinese battery makers dominate consumer markets, many industrial customers, especially in defense and critical infrastructure, prefer North American suppliers. Electrovaya's New York manufacturing facility positions them perfectly for this reshoring trend. The company is building a 135,000 square foot gigafactory in Jamestown, New York, with $51 million in Exim Bank financing. It's not just capacity expansion, it's building a moat through vertical integration and supply chain control. At around $5 per share, Electrovaya trades at a market cap of roughly $350 million. For a company growing revenue at 67% quarterly, with improving margins and a $70+ million order backlog, that valuation looks compelling. Compare this to other battery companies trading at 10 to 20 times revenue, and Electrovaya looks significantly undervalued. The company is approaching run rate revenue of $70 million annually, putting them at roughly 5 times revenue, reasonable for a profitable, fast-growing industrial technology company. The key catalyst I'm watching is margin expansion. As they scale manufacturing and leverage their fixed R&D costs across a larger revenue base, I expect gross margins to continue improving toward 40% or higher. Let me be clear about the risks. This is a small-cap stock with inherent volatility. The battery industry is capital-intensive, and scaling manufacturing always carries execution risk. Competition from larger players is real. If Tesla or the Chinese giants decide to target this industrial niche aggressively, pricing pressure could impact margins. But here's why I'm comfortable with the risk-reward. Electrovaya has already proven their technology. It works with 6+ years of field data. They have sticky customer relationships with Fortune 100 companies, and they're building sustainable competitive advantages through proprietary technology and customer lock-in. This isn't a speculative bet on unproven technology. It's a growth story, backed by real customers paying premium prices for superior performance. I've made Electrovaya a 3% position in my portfolio, large enough to matter if I'm right, small enough that I can sleep at night if I'm wrong. My 12-month price target is $8 to $12 per share, representing 60 to 100% upside from current levels. That's based on continued revenue growth, margin expansion, and multiple re-rating as the market recognizes their competitive position. The industrial battery market is massive and growing, driven by warehouse automation, electric vehicle adoption, and the transition away from lead-acid batteries. Electrovaya is perfectly positioned to capture outsized share of this trend. What do you think? Have you looked at Electrovaya or other industrial battery plays? Drop your thoughts in the comments below. If this analysis was helpful, smash that subscribe button. I'm always hunting for these kinds of overlooked growth opportunities before the market catches on. Thanks for watching, and I'll see you in the next one.
Stack it up real high. Come here to be in the know. Come here, enjoy the show. 'Cause it's Warren's money time.